Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Oh, good day, everybody. It's Tim Neary here, not Phil Tarrant today. I am editor of sister publication of the Smart Property Investment Show, Real Estate Business, and we'll be hosting a Smart Property Investment Show today in the place of regular host Phil Tarrant, who is away and wasn't able to do it today. Joining me on the show today is Redom Syed. Now, Redom has been on the show just recently and did a sort of more generic podcast around your own portfolio, didn't you, Redom?
Mm-hmm. I did, Tim.
And first of all, welcome to the show.
Cheers. Thanks for having me, Tim.
You're very welcome. Now, you were on the show earlier, did a more traditional show, and then Phil thought it would be a good idea to get you back, and it is a good idea to get you back because you have some interest in and some background in regulation, had worked for Treasury, and interestingly, in 2014, wrote a piece about sort of predicting, if you like, the APRA crackdown, the changes to regulation that we were going to see, and in fact did see, which had an effect on the market. And just recently, you've written another piece in January of this year, predicting some further changes. So I thought it might be quite good to just explore that a little bit and maybe start from there. What have you seen? What signals are being put out and what are you seeing?
Yeah, that's a really good start, Tim. So the regulators, the way they work is they go through a step-by-step process, and it sort of starts with the Council of Financial Regulators. So that is the RBA, APRA, ASIC, and Treasury sitting down together and thinking about what is happening with lending, housing markets, the financial system, and whether they need to make any changes. It's just a monitoring process and where they all sit down and talk. And what happened in 2014 was they do this regularly. And in 2014, the communication that started coming out from these regulators across the board started changing. House prices were growing very quickly at that point in time. Investor lending was ramping up. Interest-only lending was ramping up. And at the beginning of 2014, the signaling and the communication started coming out from these regulators. Now, in 2018, we're in a bit of a reverse of that situation where prices are coming down and they're coming down quite quickly, which is a scary and dangerous situation for regulators. They'd be quite happy with price falls to happen in an orderly fashion. They definitely don't want house prices to crash. And they don't think that's going to happen at this point or anything like that, but they do have discussions regularly about this. So I think if we pay attention to the signals that have come out in 2018, we may see that they have been talking in a way that expresses that they may have a little bit of worry as to what's happened and what may happen in 2019 if it continues at this pace. So the sentiment has changed from the regulators, and that really has an impact on investors. Obviously, you got to drill down a few steps. And on that basis, and following what they say very closely, I think we can sort of make some assessments as to what may lie ahead in 2019.
There's a couple of sort of moving parts that aren't there. The first one is that the market is cooling, or some markets around Australia are cooling, and that would be in the normal sort of cycle of things. So nobody's really going to get overly concerned about that, although it will raise some flags. But as you were saying, the way that the speed of the cooling, maybe going too quickly for some regulation, might be starting to raise some concerns, some red flags going off for them, because I wouldn't want the markets to be crashing. So these are the signals that you're seeing. And what steps do you think that the regulators are going to be starting to take?
Yeah, sure. So I probably talked about step one, where they just investigate and monitor.
Right.
The second step is whether they actually think action is necessary. None of these regulators particularly aim to control house prices, so that's important. But they do want to ensure financial stability, and they want to ensure a healthy economy. And falling house prices on its own isn't that dangerous, but falling house prices quickly and falling house prices off a base of negative 10% already does start to become dangerous. So that's probably step two in their investigation. And step three would be working out what actions they may want to take. And right now, they're at a point where they're sort of jaw-burning. It's very clear. The RBA governor, Dr. Lowe, came out at that CEDA dinner and said lending may have gone too far the other way. And when the RBA governor says that really has weight. Following that, the Treasurer, Frydenberg, came out in early January and said banks need to open up. And APRA's had some communication earlier in, late last year, all indicating that lending is slowing down too fast they may have tightened the screws too much. And as a finance broker, that definitely makes sense. There's been a lack of common sense sometimes at the end of 2018, probably through 2018. And much of that is probably lender sentiment and fear associated with the Royal Commission, and maybe an overreaction from credit providers. And that overreaction has created a little bit of worry from these regulators. And now they're starting to take action. APRA in December, one of the first actions was to remove the interest-only cap. Of course, that cap wasn't really doing too much, but they're still taking soft action, and that will ramp up over the course of 2019 if these trends continue, because the last quarter of last year, all the indicators were really poor. Investment lending down, lowest levels in 10 years, credit growth at half the average pace over the last 10 years, house prices in Sydney falling 4% in one quarter. These are dangerous signals. If they continued over, 4 consecutive quarters, then there'd be serious action take. Also, growth figures fell for the economy and unemployment went up a little bit. So some of these things are just trending in a little bit of the wrong direction. So they're at the early point of investigating.
So you're a finance broker. You'll be looking at these things. You'll be having a look. You'll be preparing your business. You've also a property investor yourself. You were saying that you've got 7 properties and they're all around the country. So what kind of steps are you taking, and what kind of things do you think that other investors should be looking at right now as they prepare for 2019 ahead?
Yeah, that's a really good question. So investors should really be aware of their debt terms by now. They would have heard a lot about it, but there's an interest-only expiry issue that's really coming to play around now, probably later in the year, and will play out for the next couple of years. And this is really sort of specific to investors. Why? Because investors ramped up credit in 2014 and 2015. Interest-only loan figures were at record highs for those years, and 2019 and 2020 to some degree is 5 years after that period where those loans were originally originated. So that means a lot of investors may face interest-only loans expiring this year. That in itself may not be a problem, but it is really important for investors to be aware of this and to manage it. And part of that is being aware of your financial position and your serviceability and your borrowing capacity and your equity position. Being aware of your financial picture in today's environment, not the way it was a few years ago, because it is different.
Because it's changed now, hasn't it? And the Banking Royal Commission has also changed things, and lenders might be a little bit more tight around the way that they advance credit.
Yeah, exactly. So it's about being aware of the current lending standards and your position relative to the current standards, because extending your interest-only loans, which a lot of investors may want to do to manage their cash flow, requires you to pass the 2019 hurdles now. You can't just go to the bank and say, can I please get an interest-only extension? The bank is going to say, well, we need to reassess you and see what your position is like. And they're not going to reassess you based on your 2014 lending calculator and lending policies. They're going to base it on today's lending conditions, which are drastically different over the last few years. There's been a lot of change there, particularly for investors. So an investor really needs to know where they stand in the bank's eyes relative to the current position. So that's important.
So let's explore that a little bit. Let's first of all have a look at how does the investor do that? What action should they be taking now, and what kind of preparations do they need to make? And then secondly, that reassessment is going to go one of 2 ways, isn't it? Yay or nay.
Yep.
So if it goes yay, then that's no drama. But if the bank says no, then what options do they have in that event? But let's have a look first at the actions that they need to take.
Yeah, sure. So it's a little bit like a flowchart diagram for an investor. So if they can extend their interest-only period, that's a good thing. It means that they meet the current conditions. So an interest-only expiry for them would probably be a good trigger point to review their debts. It may be a case of refinancing that loan back to a 30-year term with a new interest-only period, or it could just be a case of letting that loan continue and just requesting that the bank reissue an interest-only term so it goes for longer. And at the same time, they should probably ask for pricing and get their interest rates low as possible during that process. So that's the good case. Now, the case where someone can't refinance or extend their interest-only term with their existing bank, it doesn't mean that they have no options. It means that they need to go to sort of a secondary step of testing their borrowing power with alternative lenders and their eligibility with alternative lenders. So while a lot of banks have pushed the hurdles up in 2019, not all banks have done that. So a general case is if you could get finance in 2014, there's probably options available to you in 2019. They're likely going to be non-bank lenders who have filled up this vacuum, and you should be able to extend your interest-only period there. The interest rate might be marginally higher, so you'd have to weigh up the pros and cons of doing it. But you're likely to have options with alternative lenders. So it might be a case of refinancing your debt to a different lender. So the overarching message is an investor needs to be aware of where do they fit in. Can they get debt from their existing lenders, or do they need to go to the non-banks? And if they can't even do that, then how do you prepare for a situation where your interest-only loans expire because you don't have additional funding options or good funding options? So you need to start preparing and be like, okay, what do I do under this arrangement where I have principal and interest loans?
I quite like the idea of getting prepared for something like that. So, particularly in that scenario where there is a secondary step required, what kind of actions do those investors need to be taking? Because the non-bank lenders, do they assess the deals in a different way to the lenders? Are there other financial forms that they need to do? Is there other information that they need to provide?
Yeah, that's a really good question. So, for an investor, it's no different in terms of the way that bank looks at you. They ask for the same documents. They go through the same process. They even do the same checks. The difference is their borrowing capacity figure that they come up with is, particularly for investors, is greater than the mainstream lenders. Because their borrowing capacity is better, it means that you as an investor can pass their criteria. And when you pass their criteria, it means that they're happy to give you an interest-only term. So that's the difference. That's the key difference. They go through the same checks, the same process. For an investor, it's really the same. It's just the product is going to be different. And the branding of that product is going to be a non-bank rather than their existing lender. And that's only if you can't refinance within your existing frameworks.
Yeah, and we're sort of assuming that's going to happen. In the case where you can, then everything just continues as is, and there's no real structural change or no material structural change. Let's assume. But in the event, and I like the way that you talked about it a little earlier, where you said this is an opportunity for people maybe to take a bit of a health check on the portfolio and have a look and see how things are. Let's assume that they go into a new lender and the new lender has different criteria and perhaps it's a little more expensive. What kind of questions, I guess, would the investor need to be asking him or herself around holding on to the portfolio, or maybe letting some, particularly those that have got larger portfolios with a couple more levers involved, doing the sort of the financial assessments in terms of the added costs? What options do they have, I guess I'm asking, to absorb those extra costs in the event that they do take on extra costs? Yeah,
that's a really good summary of the position that different investor profiles are going to find themselves in. So you've touched on probably the third investor profile where they don't really have the refinancing options. What do they actually do, and how do they manage it? And you also touched on a little bit on how they manage it. And the answer to that is that investor, if, for example, they have 4 or 5 properties going to P&I inside 6 to 12 months, that could be a little bit of a cash flow headache for them. To manage that situation, it doesn't mean that they need to get rid of all their properties urgently. There's no need to do that. There's no pressure to do that either. What it would mean is to work out what level of debt is actually affordable for you under today's lending conditions. So let's say you have 4 million in debt, but you work out with your broker or with your planner that you can actually afford, 3 million in debt. If you bring your debt levels back down to your affordability limits, you'll find that the banks are now happy again to lend to you. So from there, you can go and extend your interest-only periods. And then it's a matter of discussing it with the specific lenders that you've chosen, and then they'll be able to process your loans and get you extended interest-only terms. But it's just about moving into a position where they accept you.
Yeah, and moving into position, it sounds like it's always a dynamic flow. It sounds like also that probably investors need to be obviously on top of their portfolios and know what the different moving parts of that are.
Exactly.
And then work with professionals, people like yourself, the brokers and the accountants, to understand, I guess, the different levers that are involved, which are the costs that are going out versus the costs that are coming in, and that would involve tenants as well, wouldn't it? And other moving parts like that.
Yeah, exactly. A little bit of homework for investors. Interest-only expiries are work either homework or, a little bit of management. That's what it is really.
And so that comes back to what you were saying earlier, in that there's a bit of a change ahead, but that's a good time just to have a look and do a health check on the portfolio.
Exactly.
So, Redom, talking about the changes that are ahead, and as you said, you as we said to start with, you sort of are on the inside on this a little bit because you work there, so you understand how the thinking goes.
Yep.
What other things are you seeing? What other changes can we look forward to or anticipate in the rest of 2019?
Yeah, sure. That's a great question. So, I guess this is a little bit of good news for investors. I can't imagine it getting any tighter than the back end of 2018. Some of the decision-making processes from lenders probably took out common sense in a lot of cases, and everyone was just a little bit scared associated with the Royal Commission and all the negative media associated with it. So the good news, I think, is it's not going to get any worse. And how good the news is will partly depend on how the market tracks over the course of the year. But what's possible is the regulators can tinker with existing regulations and credit policies to support lending growth. And they will do this if they feel they need to do it. And if credit growth figures remain really low, or if they continue to trend in the wrong direction, then you'll probably find that there'll be more loosening gradually over the course of the year and into 2020. So some of that loosening will assist borrowing power for investors. And there's scope to do that by adjusting what I call the APRA rulebook that all the lenders abide by. It's called APG 223 for those that love technical reading. But that rulebook sort of prescribes exactly how lenders should run their serviceability assessments. And what APRA could do is have conversations with the lenders and allow them to, at the margins, just bend the rules a little bit and apply these lending policies more favorably than harshly. And they've been taking conservative treatments in 2018. So perhaps they can take more lenient assessments in 2019. So that'll probably be the first type change that goes through in 2019. And then there's more aggressive levers that the regulators can pull. That's a relatively soft one. It'll help investors around the margins. It'll help improve borrowing power, but not drastically. More aggressive measures, could be rate cuts or changing the assessment rate that banks apply on debts. Those would be aggressive measures to promote activity in the market and to support prices and to support lending. In general, if those actions are taken, it's probably a reflection of the market performing really poorly and extreme worry. If the RBA is cutting rates, as nice as that may be for investors, there's also it's a double-edged sword. It reflects poor market outcomes, things that they don't really want to see happening. The economy slowing down would have to happen for them to cut rates. So that's also a more aggressive measure that they could take. So yeah, some of this is all data dependent, really.
Yeah. I really like the word that you use, tinkering with, because and the sort of picture that I have in my mind when you talk about the APRA rulebook is that there are all of these levers in there, and the regulator APRA would have a look at the market and see how it's going, and then tinker with those different levers as it saw fit in order for it to fit into a profile or into a set of boundaries that, if you like, that it wanted the market to stay within in order to be the safest and most lucrative way.
Yeah, exactly. That's exactly how they do it. They might not do it so prescriptively. They probably just have conversations with lenders and allow them to do it. Regulators in Australia like to take a soft touch approach rather than a hard stance. Changing a written document is a relatively hard stance. So a softer approach would be to have conversations with lenders. APRA's always continually talking with lenders, their boards, their key decision makers, and they could change the sentiment of those key decision makers by letting them take on a little bit more risk at the margins at least, and then that way they can improve confidence, and that will really help support the market.
Yeah, and that's a good point as well, is that it is a free market that we work in, so it's not over regulated, and the regulator doesn't want to be seen to be stepping in too hard with too hard an approach. However, sentiment does drive confidence, so it would influence. Can I say that? Or try and influence in positive ways the way that that market would work. Coming back to tinkering again. I like to think of that as, and I might be making up some economic terms here, so forgive me as I do that, but I like to think of that as almost like a micro sort of economic lever, if you like. On a more macro level, there's a couple of big players that are going on just at the moment. One of them is the Banking Royal Commission and the report that's due out, which is earlier on this year. And the next one, perhaps a little later on after that, is the general election. And in that, some strong sentiment about Labour coming in, the likelihood of Labour coming in, and then the impact on negative gearing to that, which is very important to investors. And then also just the cash rate and how the cash rate has been at its current position for such a long time. And sometime during this year, one would feel that it is going to move. So I'd be interested to just get your take while I've got you on the show around those three things. What are you anticipating around the Royal Commission? Negative gearing, or the election stroke negative gearing, and also interest rates going forward?
Wow, if I had answers to all those three questions and was right, I'd probably be a very rich man very quickly. So
you heard it here, folks. You heard it here first.
So this is just my thoughts. No one has a crystal ball on any of this.
And that's probably an important point as well. Is that the caveat here is that this is just sentiment. There's no crystal balling here. This is not advice. This is just having a discussion about where these things may go.
It's just one man's thoughts.
That's
really.
Right.
That's what this is. So unpacking that a little bit, the first part was the Royal Commission. So I think the Royal Commission has had a large impact already, especially with lending policies and lending decision making. I don't think it's going to impact that so much going forward, mainly because the Royal Commission wasn't specifically about lending policies. It didn't look at how lenders have their serviceability calculators and things like that. It looked at how decision making is made, cultures, and it looked at the broader market and tried to work out whether the incentives that are in place is creating a culture that's poor and produces poor consumer outcomes. So I see the Royal Commission making headwaves, but I don't think it's going to impact lending so much this year. It will have market changes. It may impact brokers, for example. It may impact different participants, the super industry, etc., or insurance providers. So it will really shake up the market and the way the market works, all with the aim of improving consumer outcomes. So I think that's going to take place. What they're going to say specifically and what the government of the day actually legislates, that's all up in the air at this point in time. But it will make headwaves, and it might impact sentiment as well. And it might have unintended consequences. So, if they do something to brokers or if they do something to financial planners or insurance providers, it may create an unintended flow-on impact to customers, which they didn't
anticipate right now.
Exactly. So that's happened a little bit. 2018 was a lot of unintended consequences from the RC, particularly with lending. So that's probably my views on the Royal Commission. And I've already forgotten what number two was.
The second one was the general election and the likelihood or not of the impact on negative gearing. And there are a couple of levers to that as well.
Yeah,
but let's say negative gearing does come into the spotlight.
Yeah, sure. So there's quite a few hoops before that actually happens. But let's assume that it gets regulated and it happens. That's a structural change in the taxation of housing. So that should create changes in the market. There may be a short-term temporary improvement to the market associated with a time gap between when they say they're going to do it and when it actually gets implemented. So they might give investors, 12, 15 months to actually make decisions, which could trigger people to jump in earlier. So it might have a short-term temporary improvement, in fact, for particular asset classes and for particular types of assets.
I like the way that you're going with that, because on the show that I do with the real estate agents, we talk a lot about how to find the opportunities in and amongst the changes when things change, and not just to go, it's doom and gloom, everything's going to be terrible, but just go, hey, there's a change. Where's the silver lining? What can we find? That's useful.
The UK's had this experience relatively recently as well. They've gone through structural tax changes to housing, to property investors not too long ago. And the general experience is there is a little bit of negativity for certain asset groups, but there are opportunities, and opportunistic investors can take advantage of these and potentially jump in, buy certain asset classes. There might be a bit more volatility in house prices, at least for a short period of time, which helps create opportunity for investors. So that might happen, but again, that's a little bit crystal ball gazing. They might even just back out of the policy because of the market.
Yeah, and we are, and it comes back to what you were saying earlier as well about when nothing happens in a vacuum. So if something happens on the one side, something else is going to happen to counterflow it on the other side at the same time.
Exactly.
And the third one was interest rates. How do you see interest rates going in 2019?
Yeah, sure. look, I think at the current moment in time, market pricing is suggesting that there might be rate rises at some point in 2019 or early 2020, depending on which economist you speak to. I personally think that housing has a very, very big impact on the economy as a whole, and it impacts a lot of other subsectors. So if housing continues to perform relatively poorly, then the economy itself may pull back a little bit. Unemployment might trend up, and there's no inflationary pressures. So in that light, I would probably go against the grain here and say the next move may be down, not up, which is a little bit unusual given the cash rate is already so low.
So low, yeah.
Yeah. But that's really data dependent. And we'll see what happens in the next few months. If we had this podcast at the end of February, we'd have a few more auction results and we'd be able to see what sentiment's like.
There'd be some more data.
Yeah, exactly. Yeah. But if the market, if auction clearance rates stay at 40% and credit continues to tumble, can't see how there wouldn't be. I can't see how the next move wouldn't be down in that light. And I could see the regulators, I can see the RBA worrying. So I'd probably suggest that the next rate might be down and it might be at the end of 2019, but that's probably a little bit different to the market.
And we'll have a look at some data as it comes out and follow this. Hey, so Redom, we've talked a lot about a whole lot of things today and started out by really having taken note of what you wrote about some of the signals that you were seeing coming out of APRA.
Yep.
And then we did a bit of crystal ball gazing. Yep. So just to end off the podcast, what I'd like to do is just bring it back to where we started and say there are a couple of changes that you've seen signaled, and really what does that mean for investors, for everyday investors in the year ahead. So just to bring it back to day-to-day stuff. What is the impact on investors in the next 12 months, and what should investors be doing now in order to prepare for that?
Yep. So just summarize it all up, right?
That was a fancy way of saying summarize it all up.
For investors, good summary is be prepared and know your debt arrangements. Know where you stand with your borrowing capacity relative to 2019 lending conditions. I think it will get a little bit easier for investors this year. I just can't see lenders applying such ridiculous credit assessments. At the end of 2018, some of the questions they asked was just getting a little bit too far. I think that's going to pull back a little bit. More common sense is going to be applied. And if I have to describe January as a finance broker, that's probably already happened a little bit to our credit decisions.
Starting to see it already?
We're starting to see lenders be faster and be less uncertain about things and just apply common sense.
And just come back to the market a little bit.
Exactly.
They sort of lost the market a little bit towards the end of last year, didn't they? It felt like that to me a little bit.
Yeah, exactly. Yeah. If you were actually seeking a loan, you would have felt it at points of last year when they asked you about your Netflix subscription or something ridiculous like that. Yeah. Now, I think January probably signals that they're just getting more reasonable and trying to do things quicker, which will help the market. These are confidence type things that will just help transactions happen and less activity fall over. So my general commentary is in 2019, lending for investors is likely to be the first time in 5 years where it starts swinging the other way, where it starts aiding investors rather than hurting investors. It's been 4 or 5 years of constant changes, tinkering, that all really hurt investors. 2019 might be the first year where that changes. Obviously, Labor Party's policy might completely flip that out the window and it might change it altogether. But in the absence of that, I think it might get a little bit easier for investors this year. So that's my high-level summary. That
sounds like a very positive outlook for the rest of the year and coming from a position of strength. And so, Redom, I appreciate you coming in today. Thank you very much for your time.
My pleasure. Cheers. Thanks for having me, Tim.
You're very welcome. Remember to follow us on all the social media stuff, Twitter, Facebook, and LinkedIn. If you've enjoyed today's show, please leave us a 5-star review on iTunes. It is the very best way for new listeners to find us and for them to get the great content that we are putting out here. As always, smartpropertyinvestment.com.au is where you'll find us. There are plenty of stories there on the business of property investment across the whole of Australia and on my guest today, Redom Syed. Thanks again for tuning in, and we'll see you next week. Goodbye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.